When we first started kind of planning what this current series of Reaching Out While Locked In would look like, one of the things that we wanted to talk about was risk management. We talked about bringing somebody in to kind of help and change things up and expose our clientele to some other folks from other states. And the first person I thought of was Josh Maples. So Josh is a good friend and colleague of mine, and I'll share more about him here in a little bit, but really glad to have Josh on to help me do some of this stuff focused on risk management and specifically talk about livestock risk protection insurance. So what Josh and I are going to do here for the next hour is really walk through kind of four things with you. I'm going to very quickly go through current markets, some signals. To do that, I'm thinking just 5 to 8 minutes, something really short. Josh is really going to cover the specifics, the nuts and bolts of LRP, how it works. And there's a lot of details there, pay a little attention to that. I'm going to come back at the end and go through a fairly simple illustration that's kind of going to be applied to a summer stocker type operation that's selling feeder cattle in the fall. And then we're going to share just some general risk management considerations with you that apply to most anything, but certainly LRP. And then go back and forth and hopefully answer some questions as we talk through some things. So share a few things quickly on the cattle market. One of the ways I've described it many times is 2021 looks a lot like 2020 did pre-COVID. And I really think that we're setting up for what should be the 2020 that we would have had it not been for COVID last year. Second year of reductions in the size of the U.S. beef cow herd. So this calf crop's going to be smaller yet again in 2021. Don't forget, too, that the real headliner from that most recent inventory report was actually the revisions made to 2019 and 2020 numbers when those were actually brought down. So some encouraging news there on the supply side. If you saw what Josh wrote, I think it's been maybe 5 weeks ago in Cattle Market Notes, he had some discussion of exports and had specifically a chart that had U.S. beef exports to China for at that time with just January 2021. But notice how similar blue line 2021 is to dotted line 2020. Again, setting it very much like we saw last year pre what happened with COVID. The biggest headwind that we've got is certainly grain prices. I just kind of picked and chose here a weekly corn price from Omaha kind of as my example. This is obviously old crop corn that I'm showing you. That this is not new crop. Things will be a little bit different by fall. But you can't sugarcoat the impact that corn prices north of $5 has on the feeder cattle market. But it does also open up some opportunities. The calf market, as we are right now, has certainly been relatively strong compared to last year for sure. COVID took out our typical spring run-up last year. Watch these 550-pound steer calves in Kentucky the last several months. I thought we'd see them on average in the 160s. I think we probably would have had the futures market not dropped like it did last week. But we've been, for a 550-pound steer state average, just under $1.60, $1.57, $1.58. Look at the value-added cattle, the fancy cattle. They're there in kind of that mid to upper 160s. But state average, we're just under 160 here in Kentucky. A couple of comments I'll make in terms of market incentives. Number one, while feed prices are not generally good for feeder cattle markets, they absolutely tend to improve returns to grazing programs. And if you're a stocker operator, or if you're a cow calving operator, or if you're a cow calf operator, calves in the fall, wean calves in the spring, wants to think about keeping calves a bit longer, and you've got grass. One thing that high feed prices do is they narrow those price slides as cattle get heavier, which actually increases the value of gain. So it increases the value of the pounds that we can add through other means. We've also got what I'm going to call an unusually large amount of carry in the current feeder cattle market. Carry is a term that's typically used in grain markets for storage. What I'm really talking about, though, is just the expectation of feeder cattle prices in the future. So now I pulled this yesterday afternoon settle. Okay, so basically where the futures market ended yesterday, I'm not showing you today. We actually rallied most contracts $1.50 to $2 today. But from where things ended on April 19th, so yesterday afternoon, April board was just under 138. We bump almost $5 from April to May, jump almost 10 from May to August. By the time we got into the fall contracts, we were in the mid 150s. When I talk about carry, what I mean is that difference in these fall futures prices and where we are right now. This is the futures market's way of signaling we expect prices to be higher come fall than they are right now. And the magnitude difference speaks to the volume of that, or the magnitude of that. Okay, so in other words, we're expecting quite a bit better prices come fall than we're seeing now. So we're going to talk to you about risk management strategies tonight, specifically livestock risk protection insurance. And it's really going to be focused on, are there things that we can do now, or things we can even do this summer to capitalize on an expectation of higher prices in the future? And that's really the focus of what we're going to be doing here for the next hour or so. So a couple more things I would say. So given that futures market, although it did drop some last week, I think there's still opportunity to add some weight to cash profitably right now. I think there's still black ink going to roll out of these stocker operations this summer. I like to make this point too when I talk to folks who either buy calves to graze them through the summer, or someone that keeps their own calves post-weaning. Understand how many of those costs are front-loaded. And I like to ask the question this way, you know, if I'm a stocker operator, simple example, if I'm a stocker operator, what percent of my total stocker cost are sunk the day I place that calf? The answer is probably 80%. Biggest cost is the value of that stocker animal, right? Then the day that I place him or her, understand I'm going to have to sell him back. I'm going to have to transport him. I'm going to have some health costs. Even things like death loss tend to be front loaded. So a lot of those costs really are sunk on day one. So there's a lot of risk that I take on anytime I place calves into a program, or anytime I choose not to sell calves I've produced and keep them longer. So by all means, we want to think about risk management opportunities related to price. This is my last slide before I tell you a bit more about Josh, but just kind of putting this in perspective right now. COVID-19 was a classic black swan event, and I'm getting sick of hearing the term black swan, frankly. I feel like we've had a bunch of these lately. But it's what that really means is it's something that's almost impossible to plan for. But risk management is all about planning for the unknown. It's about being prepared for what might happen that we may not even know is a possibility yet. So while we can think about COVID and what it did to the 2020 markets, understand so many things out there can impact these markets. Weather patterns, trade disruptions, demand shocks, we've seen those, policy changes. All sorts of things can impact the value of feeder cattle and impact what we're going to sell cattle for in the future. Also, understanding the cattle sector, we are very limited in counter-cyclical opportunities. CFAT payments were an exception of this. There was payments we got kind of after the fact, after the market dropped. But as a general rule, most of what we can do risk management-wise is market-driven. So we have to be thinking ahead of time. I'm going to end with this point right here, but you know, as cow-calf operators, as stock operators, you're used to managing nutrition, you're used to managing reproduction, you're used to managing forage, you're used to managing a lot of aspects of your operation. I want to challenge you with this notion that you need to add price risk to that box of things you've got to manage. And we're going to talk about a tool in particular this evening that's something that you can use to help you manage price risk, because very few things will impact your bottom line like an unexpected change in sale price like we saw certainly last year. So our guest tonight, my partner tonight, is Dr. Josh Maples. Josh is assistant professor at Mississippi State University. He's in a position very similar to mine. He's a livestock economist, does extension work. Josh also teaches. Josh and I work together a lot. We work together on a lot of projects. We're on a lot of regional groups together. He's someone that I reach out to a lot for his advice, for his counsel. I like to get Josh's opinion on things related to market and policy and so forth. At the end of the day, we're going to share some things with you too. Josh, myself, and another friend and colleague of ours, Dr. James Mitchell at the University of Arkansas, partner on a weekly market newsletter, Cattle Market Notes Weekly. So one of the many examples of things that Josh and I work together on. I'm really glad to have Josh on the program with me. In addition to all these things, Josh is a good friend of mine. I really respect Josh, really appreciate his friendship, his counsel, and appreciate you being here with us tonight, Josh. Thanks a bunch.
Kenny and I decided to really kind of dig deep in on LRP tonight. So Livestock Risk Protection. It's a USDA risk management agency subsidized product. There's been some pretty big changes to this product over the past, Kenny, 18 months, not even 2 years, certainly, that I think has really kind of changed how attractive this thing is. So I want to talk a little bit about this. So let's see if it'll let me. So what is LRP? It's a subsidized price risk management tool offered by USDA RMA. This is something you buy from a crop insurance agent. You find a crop insurance agent, and we can talk through some of those steps here in a little bit. But it's essentially an insurance policy. It is an insurance policy, and it's designed to offer protection against downside risk. So, last year, as Kenny mentioned, was a great example of downside risk, right? This time last year, we were watching our markets fall sharply, especially, March and into April last year. That's hopefully a really extreme case of downside price risk, but, this is a tool that would allow insurance against those types of price movements. We're going to talk a little bit about some of the things that this product is and some of the things that it's not. Sometimes it does not establish a cash price, so it does not establish a price that you're going to receive for your calves at your local auction barn. This really isn't a tool that's used to enhance profit. It's not really used to increase your profits. This is something used to manage your price risk. We put it pretty simply, it allows you to establish a price floor or floor price based on national feeder cattle prices. So it's not about what your calves do or your feeder cattle do wherever you sell them. It's about what's happening to this national feeder cattle price. And so if the national feeder cattle price declines compared to where you locked in, then that could trigger a payment. One of the big benefits of a program like this is it's similar to a put option. If any of you have had any experience trading options before, you essentially pay a premium to get the option to act if you want to, but it leaves you open to upside price risk. So if you think prices are going up and up and up, something like this doesn't prevent you from capitalizing on that. Yes, you would have to pay a premium to get the policy, but if prices go up, you're going to get that higher price for your cattle whenever you sell them. So I put together just kind of 4 quick bullet points here that I use whenever I get a call from a producer who says, "Hey, what is this LRP thing?" The first thing is it allows you to lock in a price for the future. So it allows you to sit there and say, "Hey, I normally sell my calves in August or September or whenever. I really like what the futures market is telling me about those prices come August or September that Kenny mentioned earlier. I wish there was a way that I could lock in something now. So I think the market is offering me some opportunities. I wish there was a way I could lock in something now." This product allows you to do that. It's not perfect, but it does allow you to manage some price risk in that way. So for those future prices, it uses CME feeder cattle futures. So it uses that to forecast what expected prices come, whatever your date is, whether that's August, September, or next January. The coverage periods are anywhere from 13 weeks to 52 weeks out. And so it uses futures prices to basically forecast what price is going to be at the ending date that you choose. And then whenever we get to that ending date, so let's say you purchase a policy for August, and we get to August, and the national or the CME feeder cattle index is what it uses as a trigger price. If the CME feeder cattle index, which is a collection of cash prices for feeder cattle throughout the country, and I'll show you a map of that here in a minute, if that price is lower than the price you locked in at, it triggers a payment. So, one thing that I hope you get from this, and I'm going to touch on it again later, is producers still have the incentive to get as much for their cattle as they can. There's still the incentive to use good marketing techniques to try to increase as much revenue as you can from your cattle, because this does not lock in the price that you're going to get for your physical cattle when you sell them. This is insuring against a national, or think about it as a national price. So let's dig into some of the specifics here. So some of the type of cattle that can be insured using LRP feeder cattle. And I'll briefly mention there's an LRP live cattle policy too, but given the focus of of tonight's talk, we're just going to talk about feeder cattle. So calves, steers, heifers, have Brahman or dairy are one of the big changes, or one of the changes recently, is that you can even insure unborn calves. So if you wanted to, if you still got cows that are about to calve and you want to go ahead and insure those calves for whenever you plan to sell them, you can use LRP for that. Ending weights, you have to choose an ending weight. So either under 600 pounds or between 600 and 900 pounds. Those are two different categories. The only difference there is if you pick under 600 pounds, it's going to apply I think a 10% increase in the ending price, just due to a typical price slide for higher price per hundredweight or lower weight cattle. Coverage period, like I mentioned earlier, 13 to 52 weeks. So you can get one of these things that expires 13 weeks from now, or you can, Kenny, they've been kind of doing them on a month-to-month thing. If you look at the contracts that are policies that are available, it seems to be about one available per month. So really, you can get one for pretty much any month that you're planning on selling over the next year. Maximum head per policy, which they call SCE. You can do up to 6,000 head. You can do a total of 12,000 head per year. But the big attractive thing for this is you can do as few as one. And that's what really makes this different from all of the other risk management tools that are out there. If you think about using a futures contract or using an option, those contracts are 50,000 pounds. So you got to have quite a few cattle to be able to do that. So LRP allows folks that just want to insure 10 or 15 or 20 head, however many, to still participate in some risk management, which I think is one of its key one of the key attractive things about this, especially for folks, cow-calf producers. So there's been some big updates, and this is why, LRP has been around for a while. It's not a new thing. Kenny and I, we've been doing meetings on it for a while, Kenny, but there's been some big changes to it within the past 2 years that has really kind of brought this thing more in focus. I can't remember exactly when it changed, but I think about 2 years ago, the subsidy level was 13%. And so when I say subsidy level, since this is an insurance policy, you have to pay a premium for it, just the same way that you would pay a premium for your car insurance or your house insurance. So you have to pay a premium for the insurance policy, but that premium is subsidized. And so just a couple of years ago, that subsidy rate was 13%. In the last couple of years, that subsidy has really increased. Now it ranges from 35% up to 55% of the premium, depending on the coverage level chosen. I mentioned that earlier about 6,000 head and 12,000 head. That used to be 3,000 and 6,000. So they increased the number of heads you could do per year. They changed it to where you can sell up to 60 days prior to the contract end. So what that means in simple terms is if your contract ends August 30th, you have to at least hold them until June 30th, right? So 60 days before the contract ends, and then you can sell them up to 60 days. That used to be 30 days. So it used to be you would have to hold those calves or those cattle at least until July 30th. Can insure unborn livestock. That's a new change for the 2021 crop year. And then one of the bigger ones is that premiums are now paid at the end of the endorsement period. So it used to be whenever you started up this contract, you had to pay your premium. And then when the contract ended, it paid out or it didn't. Now you can sign up for coverage today, and you're not on the hook for the premium until it ends. So you wouldn't, if you chose an August 30th period, you wouldn't have to pay the premium until August 30th. You will have to pay the premium if it doesn't pay out. If prices go up and there's not a payment triggered, you will still have to pay the premium. You're not off the hook, but you don't have to pay it until the end of the period. And that helps out folks who, if maybe they don't have the revenue coming in until they sell the cattle. So, whenever they sell the cattle is whenever they have the money to be able to pay the premium. So premium subsidy rates, it depends on the coverage level that you choose. So by coverage level, I'm referring to what percentage of that expected price do you want to get? So I told you earlier, it uses the futures prices to come up with a forecasted price. So, Kenny showed earlier, I think the August contract was around 154. So it uses, if you were going to get an LRP policy sometime in August, that price is going to be somewhere pretty close to 154 because that's what the futures market is currently telling us. So that coverage level over there on the left-hand side is the percentage of that price that you want to insure. So 100% would be 154 if that's what the expected end value is. 80% would be 80% of 154. So basically, if you choose a lower coverage level, then you're setting a lower price floor for that national price. Here's the previous subsidy rates and the revised subsidy rates. So basically, at the highest coverage levels, we're talking about a 35% subsidy. At the lowest coverage levels, you're looking at a 55% subsidy. In terms of how expensive it is, of course, if you're choosing a higher coverage level, it's more likely that one's going to pay out, right? And because it's more likely it's going to pay out, those premiums are more expensive. Just think about it. The chance that it's going to have to pay out is higher, so therefore the cost of it is higher. Similar for how long the endorsement period is. So if you choose an endorsement length of 13 weeks, there's probably less of a chance we're going to see some major market moves in the next 13 weeks than there is if you choose one for 36 weeks. So the ones that are further out, you've got that time risk built in, and that leads to a higher premium cost as well. So let's talk about some advantages and disadvantages of this. So as I mentioned earlier, the big thing is this really is one of the very few price risk management things that a small or even mid-sized producer can do. If you're selling a group of 20, 30, 40, even 50 calves or feeder cattle, maybe you hold them through and hold them out till they're about 800 pounds. But, unless you have a load, unless you have a full load, LRP is one of the very few things that you can do to lock in something this far in advance. The subsidy increase has really changed. It certainly changed the way that I've looked at this thing. Before, it was a bit of it certainly wasn't as attractive before. I'll say it that way. But since the subsidy has tripled and in some cases even increased more than that, it's really changed how attractive this thing is. So if you looked at it a couple of years ago and said no, look at it again. Take a look, just compare the premiums and look at it again. It's available in months when no futures or options are available. So, like the summer months, we don't have feeder cattle contracts, or not the summer, June and July, we don't. But, it still does use that August contract to kind of forecast prices. So you could pick a contract that ends, in June or in July when there's not a feeder contract. Coverage prices are available daily, and I'll show you some of those from today here in just a few minutes. Disadvantages, it's not as flexible as futures and options. So if you think about a futures contract or an option, you got the ability to, if you sell one, you can buy it back, or if you buy one, you can sell it. You got the ability to get in and out of those contracts. And the same kind of thing with options. An option, you still got the ability to exercise it, sometime before the ending date, whereas this thing, it basically closes out on the end date that you choose. So there's really not any time flexibility there. There's no ability to sell it back, after you've bought it. So it's not as flexible. You're still subject to basis risk. I'm going to talk about that. That is a key thing to understand about LRP is it's not a perfect match with exactly how you sell your cattle, but it's pretty close in most cases. You must own the cattle. That may not be probably not a disadvantage for anybody on here, but if you're trying to, a lot of folks like to trade futures and options, as speculators, so they don't have to actually own the cattle. But for this thing, you do have to own them. And if you're really big and you move more than 12,000 head per year, that's the max that you can do using LRP. So I want to talk about basis risk. I think this is one of the most important things to understand that I hope you get away from this. The ending values are based on an index value. And I'm going to show you how that index is calculated here in just a minute. Ending values may be different, probably will be different than the price that you get whenever you sell your cattle. So you're not locking in the price that the sale barn is going to get, that you're going to get at the sale barn. There's going to be some difference between the price that this LRP product is triggered on and the price that you actually receive. So that difference is what we're calling basis risk here. And one reason that is a concern for you in Kentucky or producers here in Mississippi or producers anywhere in the Southeast is the CME feeder cattle index is calculated using cash prices in these green states. So it is calculated using, it basically pulls market averages. So you've probably seen some, Kenny referred to them earlier. He showed you the market averages for there in Kentucky. There's market reports in all these other states. And so it's looking at the price of heavy steers in these states. And that's what it uses. It does an average of those things to come up with what the CME feeder cattle index is. So you'll notice Kentucky's not in there, right? Mississippi is not in this list. So the trades that happen in Kentucky and the trades that happen in Mississippi are not influencing that CME feeder cattle index at all. But they follow fairly closely. So what I've done here is I've plotted out the blue dots there are 850-pound steers. The orange ones there is the CME feeder cattle index. And so I've done this over time going back to 2010. And they move together, right? So generally speaking, the price of 850-pound steers in Kentucky and the CME feeder cattle index, they move together. There's a high correlation between these things. So over time, they move together. But you can see some points in here where they're not perfect, right? So if we look maybe here, I don't know if Kenny, can you see my cursor moving there?
You can see it, you sure can.
Okay, good deal. So if you look right here, in late 2018, we had some times there where it looks like the CME feeder cattle index was up above 150, maybe around 155. But the price of 850-pound steers in Kentucky was down around 140, 145. So, at any particular time, there can be some differences here. So if you had an LRP policy that ended right through here, the CME index could have been higher than what you actually got for your cattle. So it might not have covered, any losses that you had in terms of, where prices were when you booked it versus where they ended. So there is some basis risk here. And that basis risk gets even wider when you start talking about insuring lighter cattle. So this is the CME feeder cattle index, which again is calculated using heavy steer prices in those 12 states. So if we compare that to a 550-pound steer prices in Kentucky, you'll see again, they generally move together. If one of them's going up, the other one's usually going up. But there's some time periods here, and especially during the spring, whenever we see those heavy steer prices and those light steer prices kind of diverge. So you can see some time periods here where they're not always exactly the same. So this basis risk is something that we really need to keep in mind when we're booking this thing, that we're not locking in the price we're going to get for our cattle. We're locking in the CME feeder cattle index price. So I want to talk briefly about steps to getting coverage, and then I'm going to kind of show you some of the stuff online, and then Kenny, I think, is going to walk us through a couple of examples of this. Find an LRP agent. The USDA RMA website, has an agent locator tool. Most of these are crop insurance agents. They are crop insurance agents. Fill out an application, it's accepted, and then after you get the application done, you don't have coverage. So that's kind of the first step. It's a simple thing, just completing the application. And basically at that point, then you have the ability to go purchase a policy if you want to. So if you're thinking about it, you can do the first steps without having to worry about, actually having one purchased yet. So you can go into the first steps, and then that allows you to call up your agent and say, hey, this is what I want to do. So once you purchase one, so you choose your ending date, pretty close to whenever you're planning on selling your cattle. At the end of that insurance period, if the actual ending value, so if that CME feeder cattle index is less than the coverage price you picked, then you're going to get a payment. You're going to get an indemnity payment. If the ending value, so let's say the CME feeder cattle index on your ending date is higher than the coverage level you picked, then you're not getting anything. You're going to be, you have to owe the premium that you signed up for, but you're not going to be receiving a payment. But your benefit there, of course, is prices have gone up, and hopefully that means you're going to get a higher price for your cattle when you sell them. If the producer's owed an indemnity, they got to submit a claim within 60 days, and payments are made within 60 days of that. A couple of, the availability on this thing is something to get used to. Policies can be purchased any weekday, but they can only be purchased from the time that RMA publishes prices. So that's around 3:30 my time, so about 4:30 Eastern time usually is whenever those prices and policies go online, until 10 a.m. or I got 9 a.m. Central time here, so until the next morning basically. And the reason this is because of when the futures markets trade. So since this thing is based off what CME feeder cattle futures are, they don't want to sell it whenever futures are trading, because then, so it's only available whenever markets are closed essentially. Not all coverage are available every day, so the coverage options change each day when you look at it. We'll show some of that here in just a second. So there's the RMA Agent Locator. Whenever I pass it back over to Kenny, I'll drop a couple of these in the chat box. LRP coverage rates and values. And of course, I got a website with more information. But I want to just kind of show you what the website looks like a little bit here. So this is, if you go to their coverage rates and values, and then you go in here. So this is from today. I went to this website 2 hours ago, and I grabbed a couple of screen grabs. So for effective date today in Kentucky, feeder cattle, there's 2 different weight classes for steers. You can also do heifers. Really, the only difference there is they apply a 10% increase or 10% decrease, just depending on what type of cattle they are. But for steers weight 2, that would be the 600 to 900 pounds is what we're going to look at here. That's just there's no adjustment on those. Now, I know you can't really see these. I'm going to zoom in just a second, but here's a list of just the first page that pops up. These are the list of available policies for 600 to 900 pound steers. And so I'm going to zoom in here. And these are the ones that are available with an ending date of August 17th. So that will be 17 weeks from now. So in Kentucky, we're looking at endorsement length of 17 weeks. These are steers weight 2. That means they are between 600 and 900 pounds. If you see over here, the crop years this year, the expected ending value. So that is basically since this is August, it uses the August futures price to come up with what the market is currently expecting the value of feeder cattle to be in August. So Kenny showed you earlier that was about 154. The expected ending value here is 154.40. So then you'll see these coverage prices. So that's the expected ending value. That doesn't change. But depending on which coverage level you choose, so these are all the different coverage levels for just this one ending date, that changes your coverage price. So up here is the highest level of 98.36%. So if you chose that highest coverage level, that will get you a coverage price of 151.88. All that is doing is saying, this is the ending value, multiply it by 98%. I'm getting a coverage price of 151.88. Over here is your cost per hundredweight. So this is the premium rate. This is the total cost on a per hundredweight basis. So you'll see, like we talked about earlier, if you choose a higher coverage price, your premium cost is going to be higher. As your coverage price goes down, it's less likely this thing's going to have to pay out, so it gets cheaper. all the way. If you come down here to selecting a coverage price of 135, that's pretty much going to cost you nothing, because this thing is going to be subsidized pretty heavily. So it's going to be really cheap. So I just wanted to show you all the different things that are, all the different choices that are available. Kenny, I'm going to try to wrap it up here and get to you. So just summary here: LRP protects against national price declines. It allows producers to take advantage of strong markets like we've seen the last couple of weeks. So these are feeder cattle futures. I think this is the August contract here, or maybe this is September contract. You know, we've seen feeder cattle futures on a pretty sharp run up basically since last May. You know, since we came out of the tough times last spring and summer, they've been on a pretty good run up. They topped 160 for the September contract. So, you know, so right through here, you know, we're looking at some opportunities to take advantage of that strong market. It's not a replacement for marketing strategies. You still need to try to get the most you can for your cattle. And really it stands out, Kenny, because it's one of the few tools available. And with the new changes to it, it's become a more attractive one of the few tools available. So with Kenny, I think you're going to walk us through some maybe examples. So I will kick it back to you.
Thanks, Josh. So the last thing that Josh and I wanted to do was really kind of walk you through an illustration, kind of pull some pieces together here. So we're going to apply this to a simple stocker scenario. So we're going to almost pretend like I'm placing stockers today. We've kind of done this to keep the math fairly simple. We're going to assume they're going to gain 1.5 pounds a day on average between now and fall. We're going to have them grazing for 167 days. And we're doing that so they finish at exactly 800 pounds. And we're just doing that to keep it simple. So that's exactly what the CME index is based on, is an 800-pound steer. We're going to assume basically 3/4 of an acre per head for grazing. And we're going to kind of pretend like we're purchasing these calves for a stocker operation, but understand the same exact math applies if these are calves you produced. By not selling those calves and keeping them, it's the same thing as if you bought them. You gave up that money on those calves, so that kind of becomes cost number one. So again, when I put this together today, based on Monday's futures prices, you know, the fall board was around 155. Okay, so you know, Josh did a really good job talking about basis and thinking about, okay, what does a 155 fall board really mean for me in Kentucky? You know, so as an example, this is very individualized, but as an example, I'm going to assume about $10 less than that for a Kentucky basis from that. So in other words, if the board's at 155, I think that probably means this fall I sell cattle for $1.45 at that same weight range. So that's where that basis comes into play. I've got some cost here. I'm not going to walk through them, you know, in a lot of detail, but I've got an expected stocker price here, what I'm going to place calves for $1.60, so a little bit above our state average price. I've got pasture cost in here at $70 an acre. That's a combination of pasture rent and think about pasture maintenance costs. That's going to vary, of course. I've got mineral, $25 vet and medicine. I've got full sale expenses in there if you're paying for small group commission. I've got $10 a head to haul, $10 for other waters kind of used sometimes. Every other category from municipal water. I've got 5% interest, 2% death loss. So I've got an estimation of some costs there. What I want you to focus on, though, is that given what I think I could place some 5-weight steers for right now in a grazing program, and an expectation of selling 800-pound steers come fall for $1.45, I'm projecting a return in the $85 to $90 range per head. Okay, so that's what the market is looking like right now. Now let's think about how LRP would apply to that same scenario. So I'm planning to sell heavy feeder cattle. I think they'll weigh about 800 pounds. I think they'll be ready sometime in October. I'm worried that the market's going to change and the value of those cattle between now and October is going to go down, or another way to say it is they're going to bring less than I think they will come October. So what I could do, I could purchase an LRP policy with an ending date in October. Remember, Josh said there's one of these offered virtually every month, roughly every 28 days. Okay, so there'll be one available for October. He showed you some August earlier. Based on where October futures were yesterday, that expected ending value that he talked about was 155 a hundredweight. Okay, I could buy a 150 coverage level. At the time I ran this, something like that would have cost about $4.50 per hundredweight. When I apply that premium subsidy of 35%, that brings me down to something very close to $3 per hundredweight. Okay, so on an 800-pound steer, $3 per hundredweight, my insurance cost will be around $24 per head. I'm going to kind of use round numbers. It won't be exactly that, but something close to that gets you in the ballpark. Okay, so I'm considering the basis here that if that index is 155 and that's my expected ending value, that probably translates into something like $10 a hundredweight, less than that in Kentucky, and I probably sell those steers for $1.45. Now I want you to understand this number. If I do what I just described, I have probably set a price floor for my cattle around 137 per hundredweight. And here's where that comes from. I've got a CME index coverage level, an LRP coverage level at 150. If the market does get down to that point, if futures do get below 150, then I start to make money, or I start to get indemnified through the policy. Okay. But if that's the case, probably my cattle sell for $10 back of that. That puts them at 140, and I'm still out $3 a hundred for my insurance. So that brings me back to my $137 a pound, or 137 per hundredweight. So that's the floor that I think I've set. So the simple way for me to think about this is that becomes a cost in that budget. So all I've taken is that exact same budget I showed you earlier, placing that 5-weight steer $1.60, moving an 8-weight steer come followed $1.45, and I've added a $24 cost in there for LRP insurance. Okay, and I've knocked $24 off of that expected return to land capital management. Not insignificant. Okay, notice though it's still positive. Okay, that becomes a cost just like anything else that I've got: pasture rent, mineral, sale expense, what have you. That's a cost. Now we're going to walk through 3 scenarios here very quickly to show you how LRP would work in practice. So the first scenario is the one that Josh described earlier in a general sense. He talked about, what if the market really takes off and it gets better? Best case scenario. Okay, let's say that LRP ending value that was expected to be 155 actually goes to 175, meaning the futures market goes up by $20 a hundredweight between now and sale time. Well, if that's the case, I sell my cattle on a stronger market. Instead of selling my 8 weights for 145, I sell my 8 weights for 165. And I'm tickled to death with that. I'm still out $3 a hundred, or $24 a head for my LRP insurance, but my net price for the steers becomes the 165 that I sold them for, minus the $3 a hundred that I spent on the insurance. This is the best case scenario. I look back when it's over and say, gosh, I didn't need the insurance. But that's the best case scenario. I'm much better off. Now all I've done here is I've dropped that new sale price, that better sale price, into that same budget. Okay, I've sold those cattle now for $13.20 roughly. And notice that return that I thought was going to be something like $65 is north of $200. Okay, best case scenario. Now, I'm still $24 worse off than I would have been had I not bought the insurance. I don't want to mislead you at all. Okay, in this scenario, I bought the insurance and did not need it, which means my neighbors who did not buy the insurance may well be $24 better off than me when they sell their cattle in the fall. Okay, but I had downside protection and they did not. When you buy LRP insurance, like anything else, best case scenario is you buy the insurance and you don't need it. Number 2, prices can fall a little bit. I'm going to go through this kind of quickly, but here's another possibility. Okay, I've bought coverage at 150 with an expected ending value at 155. It's possible that the futures could fall just a little bit. Maybe that goes from 155 to 152. It does in fact drop by $3, but it's still above my coverage level. So I get no insurance help. I do in fact sell my cattle for a little bit less. Instead of selling for 145, they sell for 142. I'm still out $3 for the insurance that I bought. I pay that premium either way, no matter what happens. My net price for the steers is 139. They sell for 142. I get no help on insurance. I'm out $3 on the premium. Market fell, but I did not get an indemnity. This is a little bit like having a $1,000 deductible on a car insurance policy and having a fender bender. That happens. Okay. Bottom line is I was insured. I just didn't have a deep enough loss for my insurance to kick in. Plug that in here. I plug in the lower sale price, the $142. I've still got my $24 cost for the insurance, and that return now is at $38. I'm not happy about it. It's not a good return I'm pleased with, but we all know things can get a lot worse. This is not worst case scenario. Final example I'm going to show you, or final illustration we want to share with you. What if the market really drops? Okay, so this is something like COVID in 2020. This is something like the 2015 feeder cattle market. This is something like what happened after BSE in 2003. This is something like a major change in corn price one year. Let's say that the market drops 20 bucks. That expected ending value that I thought would be 155 for CME index is actually 135. It's dropped by 20 bucks. I sell my cattle for something probably closer to 125. They sell for $1,000 a head. I'm still out $3 on my insurance. We all know this would be a train wreck, except this is when the insurance kicks in. I've got a coverage level CME index at 150. That ending value CME was at 135. So I've got a $15 per hundredweight indemnity coming to me. On an 800-pound steer, folks, that's $120. That's $120 per head. It should be head, I'm sorry, $120 per head. My net price for the steers is 137. I'll walk through them very quickly. I sell these steers for 125 per hundredweight. That's a terrible market based on what I paid for them. I'm still out $3 a hundredweight, but I collect $15 in indemnity. That brings me to 137. And this brings me back to that exact price floor that we thought we'd set earlier, because in every example, we've assumed that our basis was about $10 under the board. In this case, the insurance paid out, and I'm glad I had it, but this really is the worst possible price result, okay? And here's that final budget scenario. Okay? Sell those cattle for 125, they bring about $1,000 a piece. I get a $120 indemnity, which helps a lot. I'm still out $24 for insurance. But again, folks, this is not a return that I'm going to want year in, year out by any means, okay? But again, what does this look like if I don't have the insurance in place? Folks, this number is negative to the tune of about negative $80 or so, okay? So understand what having insurance in a year like this did, right? It prevented me from going in the red and taking a major, major loss. Again, this is worst case scenario, but LRP insurance made the worst case scenario much more manageable or much more palatable. I'm going to show you this a couple of different ways to kind of drive the idea home. So this is more of a tabular explanation. So same exact scenario. I'm buying that $150 coverage level. We're assuming $10 basis and $3 premium. Okay. First column here is that LRP ending value. Understand going in, we expected something about like 155. Next column's Kentucky price, just $10 back of that. Next column's that $3 premium. Okay. Second column from the left, this is the indemnity. Okay. Notice my coverage level's at 150. So until I get below 150, there's no indemnity. I've got no insurance kicking in yet. Okay. Once I get below the 150, I start to receive indemnity. And that net price, notice what it does. Net price improves in a stronger market, but it flattens out and it bottoms there at 137. This is the price floor that we've set subject to basis risk. In a table form, this is what that looks like.
Every word out of his mouth is a lie.
I'll show you a graphical approach too. This may help as well. If you're more of a graphical person, sometimes this is a bit more informative for you. On the y-axis, think about this as my net price per hundredweight. What I actually net for the cattle. The x-axis is the overall market. If I have no price protection, the overall market's good, my price is good. Overall market stinks, my price stinks. It's that simple. I live and die by the overall cattle market. We didn't talk about forward contracting. Josh mentioned futures, of course. You know, think about something like hedging or a forward contract. If I can lock in a price somehow, and I locked in something like the 145 we were expecting, it doesn't matter what the overall market does. I'm locked in at 145, period. I've got no upside and no downside. This is what LRP looks like, okay? In a strong market, I don't do as well as no price protection because I spend some money on premium. Sorry, spend some money on premium. That $3 that we talked about in my example, okay? You know, in a weaker market, in a down market though, what LRP does, it stops the bleeding, okay? It sets me a price floor in place, okay, which gives me some downside protection, but then I can still benefit as prices go up. So that red line LRP, think about that graphically, what it does. I've got downside protection, a price floor in place, but I can still benefit if prices go up and I set a floor. I do not set a ceiling. Last thing we're going to do here with the last maybe 3 or 4 minutes is just kind of share some basic risk management thoughts. Those of you who heard me talk before, I've shared similar things with you before. Josh, I want you to stop me and chime in anytime here, buddy, if you have thoughts and ideas you want to add, by all means. But to me, one of the first things you've got to do to understand risk management is to know how changes in price impact your profit. I like to ask producers about things that have the biggest impact on their bottom line. And they'll always shout out some important costs. But folks, there's not a single number in a budget that's going to impact your profit any more than sale price. Understand that, okay? Think about if you've got an expected return of $80 a head, selling 800-pound steers in the fall, understand a 10-cent decrease in price takes your profit from $80 to zero, okay? $120 profit, a 15-cent change in price takes your profit from 120 to zero. Understand how sensitive profit is to changes in price. Know what tools are out there. Josh made a really good point that LRP is just one tool that's out there. It's one that we like because it's affordable for the most part, and it can be bought in small quantities like most of the folks we work with are dealing with. But know what's out there. LRP, futures and options, forward contracts. You've got a lot of tools at your disposal. Find one that works for you, okay? Also stay in tune. I think it is very likely that we're going to see new price risk management tools at our disposal over the next few years. There's a lot of discussion about some new things coming down the pipeline eventually. So be aware of what's out there. Big picture, when you manage price risk, you're looking for long-term stability. You're not chasing price, okay? If you do a good job managing price risk, it's much like a baseball player that hits a lot of singles versus one that hits a few home runs and strikes out a lot, okay? You're looking for base hits. You're not going to hit the home runs as often as some of your neighbors that do nothing, but you're also not going to have the really ugly periods that they're going to have as well. It's about smoothing out returns more so than maximizing price. Another reason I like LRP is because it's simple. And folks, you know, one thing I've learned in my career is there is nothing wrong with simple. Some of the most frustrating conversations I've had with producers on the phone have been ones that have tried to use futures or option strategies. They work through a broker, they've done something through online brokerage, and they'll call me and they'll say, Kenny, I don't understand. They'll say something like, I bought a put option and I'm getting margin call. And I'll say, well, that's not possible. And then they'll send me their paperwork, and sure enough, they've done something complex where they've actually done something they didn't understand. And I'm not saying what they did was wrong from a risk management perspective, but it violated the first bullet here on this slide. You need to understand what you're doing. And that oftentimes means you start simple and you add complexity as you learn more. So if you need to understand, there's nothing wrong with simple. Set pricing targets ahead of time. Personally, I see nothing wrong with pricing cattle the day you place cattle. I see nothing wrong with that whatsoever. Now, you may choose not to do that, and that's perfectly fine. But I'll just warn you, it is really hard to manage price risk in real time, okay? You may say to yourself, gosh, the market looks really good, or I'm going to go ahead and lock in these prices. But the back of your mind, you're going to be thinking, you know what, this market's at 165. I think it may go to 170. I'm going to wait. And you'll talk yourself into doing that time and time again, and you'll lose your market. Or the market's moving down, and human nature, we don't want to lock in a price that's lower today than we could have got yesterday, okay? So I tell folks, you want to automate this. You want to say, okay, the day I can get this price locked in or this floor locked in, I'm going to grab it, period. Autopilot done, okay? Don't make the decision on the fly. It's just too hard. You will have analysis paralysis. Second to last point, don't look back after decisions are made. It's inevitable, if you do a good job managing price risk, that you will jump on a market too early. It's inevitable you're going to do it, okay? So I tell folks, first of all, make sure you're comfortable with what you do. If you buy an LRP policy today, make sure you are okay setting that price for and okay writing that check come sale time period. Okay, that's number one. When you do it, reach up, grab the rearview mirror, pull it off the truck. You do not look back. You cannot manage price for looking back. You have to look forward. So make the decision and move on. Okay. Last point I'm going to make. I think I use this all the time, so I apologize. You probably heard this before, but I always like to say that, if you're not leaving money on the table occasionally, and folks, it's human nature. None of us want to do that. We all intuitively, we want to do as well as we can price-wise. We hate the idea of leaving money on the table. But I always turn this around and say, if you're not leaving money on the table occasionally, you're probably taking too much risk. And be strategic about the risk that you can take and how much risk you can bear. It's different for all of us. But LRP is a tool that you absolutely can use at your disposal to manage some of this downside price risk, which is becoming more and more of an issue for us all the time. This is my contact info. You should be able to get in touch with me pretty easily by either phone or email. Follow me on Twitter at KYCattleEcon. Last thing I want to show you here, I mentioned this earlier. Josh, myself, and James Mitchell partner on a weekly cattle market notes, or a cattle market notes weekly, which every Monday afternoon we put out a market analysis, market summary. A lot of good info there. The articles tend to be market related. One thing that I'm really proud of, though, this tends to be more cow, calf, and feeder cattle focused. A lot of stuff that's out there is very much fat cattle focused. But, Josh, myself, and James being in Kentucky, Mississippi, and Arkansas, we're cow-calf stocker backgrounding type states. So we kind of write with that in the back of our mind. So I would encourage you to sign up for this. We've got a QR code there. If you want to try and scan that, you can get to the sign-up page there really easily. We'll also drop the link into the chat. Some of you may get this forwarded to you from your county agent, but that's also fine. But if you want to get it directly sent to you on Monday afternoons, we definitely want to encourage you to sign up, and we would be appreciative if you would.